Joining us now from Omaha is Bill Smead. He's the Chief Investment Officer at Smead Capital Management. Great to see you, Bill. I have to imagine it's a pretty jovial mood out there.
Well, it is, but it's also, Charlie's not here. And
True.
If you're a big Charlie fan and Warren was a big Charlie fan, it's just different than it used to be.
Yeah, no, and I was going to bring in my Charlie paraphernalia. I've got a squishmallow, a rubber ducky, various other things. And thank you, everyone who sent them back over the years because they're prized possessions. Of course, his Market Wisdom, all of those books that everybody's read, or if they haven't, they should. And we'll miss his pithiness on all of these topics, right? So as a shareholder, though, I mean, this company just continues to perform throughout these difficult economic environments.
Yeah, I think that in the difficulty that the tariffs created, people snuggled into it as a safety trade or kind of a staple, which is kind of ironic because it's probably as representative of the gross domestic product of the United States as just about any company. So I'm reminded my first shares were in 1990 when we were bombing Baghdad in shock and awe. And, of course, the stock has been unbelievable during that time period. But remember, Warren is playing defense right now. And the number one question people want to get out of Warren is, OK, Warren, you've built this massive cash hoard. Why are you doing that? And how do you view the overall market compared to historical junctures that you've been more cautious in the past? Right.
And I read the letter where he said, look, we remain committed to equities. Like, we're not changing that. They're not trying to be, a T-bill fund or something like that. But I take his point. It's hard to find the right targets to buy. What's going to give them that ROI that's going to be better than the market and that's worth going out and picking up here? What's big enough, right? I mean, I'm sure they get mom and pops coming to them all the time, but that's not going to move the needle.
Yeah, and there's the most interesting dichotomy right now between there is very high bearishness at the American Association of Individual Investors, which is dominated by probably 50 to 70-year-olds that are kind of more conservative with their stock money. They've been more bearish the last 10 weeks than they've had in 10 weeks since 1990. But yet, if you look at the Buffett indicator, which is the total market indexes compared to the GDP, this correction hasn't even put a dent in the overvaluation of the total market index. So you've got this strange dichotomy. There's things that are cheap out there and very attractive, but they're so deeply out of favor, it's not what people buy when they get re-excited about the stock market.
That would be a great question for him, actually. Is it time to walk away from that indicator? I mean, is it literally just that because of technology or for whatever other reason that multiples are just higher now than they used to be?
Well, that could be, Kelly, but if you look at all the historical junctures, people always say it's different this time, right? That technology now makes you should be willing to pay 22 times earnings to buy the S&P 500 index because it's just so much better than it used to be. Well, a lot of that enthusiasm is associated with tech and it's associated with AI. And what history has taught us, whether it was radio in 29 or landing on the moon and the semiconductor in 1969, or whether it was the dot-com bubble, the actual stock market excitement about those things was all front-loaded. And then we went through 99 to 09 where the S&P was flat for 10 years. So we really like there's great things to buy out there, and we're very enthusiastic about what we're doing, but we're not involved in those price areas of the market that have been so popular. And I think Buffett is trying to tell people through his behavior where he thinks things are going.